One of the most common questions that we receive as financial advisors is, how long will my money last in retirement? And there's really two main factors that we need to consider. One, what are your withdrawal needs, meaning how much would you like to withdraw per month out of your nest egg? And two, and I would say most importantly, is how is your nest egg invested? In this video, we're going to cover both of those topics using the story of Jack and Jill. So here we have Jack, and Jack has saved $1 million for retirement, and he has it invested into the broad stock market. Now, this is probably one of the most common retirement investments. A lot of people love the stock market. And so let's say that Jack decided to retire in January of 2020, right at the turn of the millennia. Let's see where he would have been just 10 years later investing in the stock market. And let's do a common income withdrawal amount of 4%. Many of you have probably heard of the 4% rule. Whether or not the 4% rule is right for you personally, I couldn't tell you. I don't know you, but this is just for example purposes. We also want to incorporate inflation into that, so we're going to do an annual income withdrawal cost of living adjustment of 3%, meaning that Jack will withdraw 3% more each year out of his portfolio. So let's see, just 10 years later, where $1 million got Jack. So if we take a look, here is the month, the year, and his beginning balance of $1 million. Now, some of you may remember the turn of the century. We had several bad years with the dot-com bust, and you can see the change in value in his investment nest egg. Although he's still withdrawing because he needs retirement money, and so you'll see each year he's withdrawing a little bit more. That's that 3% to account for inflation. And here is the year-end value of his portfolio. So investing in the stock market, just 10 years later, his $1 million is now a third of what it once was, $333,000. Now, he didn't necessarily do anything wrong. He put it in the broad market, withdrew that common 4% rule, and look where he is after just 10 years. Now, let's take a look at where Jill would be. Now, Jill, she saved up $1 million just like Jack did. She put it in the broad stock market, the S&P 500, just like Jack did, except she retired in January of 2010. So now let's see where Jill is after 10 years, beginning in 2020. So let's just go back here, and let's put Jill, $1 million, S&P 500, and let's move that up to 2010. And we'll go to 2020, same withdrawal, same cost of living adjustment, and I'll show you the stark difference. Now, Jill, same money being pulled out of her portfolio, and look at what she ended with after 10 years. Not only did her balance not go down, she ended up with more than double than what she started with the same investment and the same withdrawal rate. So how does that happen? Well, this is what we call sequence of returns risk, meaning Jack had multiple negative years right in the start of his retirement, whereas Jill was able to benefit from some positive years in the beginning of her retirement. So even though they're withdrawing a set amount, it completely depends how their money is invested, whether or not it may be successful for them. And so that's the point that I want to drive home in this video. And now we'll show you generally a foundation for how we begin to set up a retirement income portfolio. So here we are again with Jack and Jill, and I just want to highlight the differences before we begin looking at the portfolio. Same investments, 10 years. Jack ended up with $333,000, and Jill is over here with $2.2 million. And same investments, same withdrawal schedule. So how do we avoid that happening to you? How do we make it to where you don't have to wonder where you'll be in 10 years from now? So when we develop your income plan, we take a look at some of the following investments. This is what we've dubbed our all-weather strategy. Now, this is not a trademark term. You may see this term in other places. But this is what we've developed as a foundational strategy to build off of based on your time horizon, your risk tolerance, and your income needs. So I don't know if this strategy is right for you since I don't know you, but again, this is just the general foundation to give you an understanding of where we start when we begin building income plans. So we take a look at the largest slice of the pie here, this 50%, and we like that in the stock market, again, depending on the risk tolerance. This is because the stock market tends to outpace inflation over the course of time, which is important to maintain your spending needs in retirement. You can also use dividend stocks to provide consistent retirement income in the stock market, but it is not guaranteed, and so you may lose value. And it does fluctuate. We all remember 2008, we remember 2020. What if you retired in those years and began to draw from your assets? So it's very difficult to draw from your portfolio when it's down in the dumps, both mathematically and psychologically. And so what do we do to potentially offset that? Well, we like to start with potentially a third of someone's portfolio in what we call safe money. This is this light blue section here. And in this area, we generally structure it to where your principal is protected, meaning you put $300,000 into this bucket, and all $300,000 will not go down if the stock market crashes. You also, in this bucket, have potential for guaranteed growth, guaranteed income, and it's mostly illiquid, which is something that we need to be careful of. There's always trade-offs in investments. And so for all that safety, we need to make sure that we don't put all of your money in there because it will be mostly illiquid, meaning you can't just pull out lump sums from that part of the portfolio. Typically, we'll have a set amount that you can pull, and in some cases, a few larger chunks, but again, for the most part, it's fairly set. Also, since there is no downside risk typically in this bucket, you will potentially have lower returns than you would here in the stock market. Again, the stock market, you have unlimited growth potential, but you also have 100% loss potential as well. And so the idea is, let's say that Jack utilized a strategy like this, and in the first few years of his retirement, he relied more on the safe bucket of money over here rather than withdrawing from his stocks when they were down for those first few years. Then, when the stock market recovers, he can take some pressure off of the safe side and begin to withdraw more from the stock market side. So it's very fluid. And over the course of time, your portfolio will slightly adjust here and there as we do reviews and make changes to it. But this is how you're able to potentially insulate yourself from that sequence of returns risk that we've seen in those stark differences between Jack and Jill, again with the same investments, same withdrawal rate. The other portion of the portfolio that we've been utilizing more and more over the last several decades is what we call alternatives. Now, alternatives is a very broad term, and essentially what it encompasses is anything that's typically not traded in the public stock market. So this can be real estate, this can be privately held companies that haven't gone public yet. There are more and more private companies staying private for longer. In fact, since the late 90s, there are fewer and fewer publicly traded companies every year, which I found quite interesting. So again, more and more opportunity in the private space. Now, these may not be right for you. Again, I don't know you, but the potential upside to alternatives is they're in some cases uncorrelated from the stock market, meaning in those first few years when Jack was suffering those losses, alternatives may or may not have been down with the stock market. They could have been flat or even positive. Therefore, he's not, killing worker bees, withdrawing his principal while it's down. And so he would withdraw from the safe side of the bucket and the alternatives rather than the stock market. This also has the opportunity or potential to outpace inflation, which is important, and you get diversification into the private companies. Now, I will warn you, this is not guaranteed. It is mostly illiquid. You're literally putting your money into private companies that you can't just reach into the cookie jar and get all the cookies out whenever you want. And there's potentially higher fees involved with alternatives. So again, they're not suitable for everyone, but this is a general starting point of what we look at when we're building a retirement income portfolio. So the entire goal here is to make it to where you're able to withdraw the same amount of income each year, generally speaking, and not have your portfolio or your hard-earned nest egg be exposed to such volatility. And so again, if we have down years in the stock market, we'll focus on the safe money side or the alternative side in order to receive your money for withdrawals. During the good years, we'll focus on the market side. And over the course of years, we'll rebalance these buckets or these slices of the pie to make sure things stay balanced. During bad years, not only will you focus on the safe money side for your income, but we may also buy some of those stocks in the stock market while they're low. And then as the market recovers, we may skim some cream off the top and put it on the safe side. So this, starting with $1 million portfolio, will give you a lot better potential, again, to avoid the situation that Jack found himself in. And since nobody on this earth knows where the next 10 years will go in the market, these are things that we can control and that we find suitable to implement, again, for the clients that we've met with. Now, if you're interested in how this all-weather strategy may be right for you, click the link in the video description below. It'll ask you a few questions. What I'll do is I'll take that information and I'll record a 60-second private video that I'll send directly to you that you can watch on your own time. And it will give you my opinion of where you may be at for your retirement income and maybe some potential things to consider. Thank you so much for watching, and we'll see you next time.